Hello everyone. Let's talk about something that affects us all. India's trade and investment landscape. Over the past few months, foreign investors have pulled out over 28 billion from our market. That's a huge shift. What's going on and what does it mean for our economy? Let's break it down. India has always been a major attraction for global investors, but recently, concerns over policy changes, the rupee's volatility, and global economy concerns have made investors hesitant. The government is now planning to double the investment limit for individual foreign investors from 5% to 10%. While this may bring in more capital, it also raises questions. Will this lead to foreign takeovers? Will companies struggle with compliance? To understand today's issues, we need to look at the history. In 1973, India introduced the Foreign Exchange Regulation Act, or FERA. Its goal was to restrict foreign ownership and protect our economy from excessive foreign influence. However, this led to a rigid and bureaucratic environment where companies struggled to attract necessary foreign investment and capital. It discouraged global firms from investing and caused inefficiencies in trade. Recognizing these issues, the government replaced FIRA with Foreign Exchange Management Act, or FEMA, in 1999. This shift allowed greater foreign participation, contributing to India's economic boom in the early 2000s. Now, decades later, we are facing a similar debate. How much foreign investment is too much, and how do we maintain control while fostering growth? Here's a three-step plan. Clear regulations in the next 6 months. The government and RBI must provide clear guidelines to ensure transparency and boost investor confidence. Incentives for long-term investments, 6 to 12 months. Offering tax benefits to foreign investors who commit for longer periods can stabilize markets and reduce sudden withdrawals. 12 to 24 months. Strengthening domestic investment. By improving corporate governance and strengthening our financial markets, we can reduce dependency on foreign money and keep our economy resilient. However, implementing these measures comes with its own challenges, such as regulatory hurdles. Crafting policies that are transparent and predictable while balancing national security and economy openness is difficult. Past policies have often suffered from abrupt changes, discouraging investors. Geopolitical risks. India is affected by global trade tensions, especially with the US-China rivalry. Sudden shifts in global policy can impact foreign investment decisions. Currency volatility. The rupee's fluctuation make foreign investors cautious as their returns are affected by exchange rate risks. Corporate resistance. Many Indian businessmen fear that increased foreign ownership might lead to loss of control over key industries, leading to lobbying efforts against liberalization. Striking the right balance between attracting investment and protecting national interests is the real challenge. But here's the bottom line. India has the potential to be a global economy powerhouse. By learning from our past, implementing smart policies, and staying ahead of the curve, we can ensure a strong and more stable future for our economy. Thank you.